Now let us consider the functions of accounting. There are various functions of accounting. The major ones are, one is called the measurement, second is called forecasting, third is decision making, fourth is comparison and evaluation, fifth is control, and sixth is government regulation and taxation. The measurement here means measurement of the recorded transactions. That means transactions, in order to be able to be recorded, have to be measured. And how they are measured? Normally they have to be measured in terms of money, because only what can be measured in terms of money can be recorded. And how to record in terms of money? What are the different concepts relating to measurement of money, which we will see later when we talk of accounting concepts. Suffice it to say that measurement is always done in terms of money. For example, in the case of India, all transactions are measured in terms of the home currency of our country, that is rupees. Whereas if you go to USA, all transactions will be recorded in their home currency, that is US dollars. So measurement is one of the important functions of accounting. So what can be measured only can be recorded, what cannot be measured cannot be recorded. Then forecasting. So accounting also is involved with forecasting. Normally there is a misconception saying that accounting is only related to what has already happened. But accounting also takes care of some forecasting. For example, if you want to calculate depreciation, we have to forecast what is the useful life of the asset. That means how long this particular asset can be used and what would be the value which we will get at the end of its useful life. That is what we call the residual value. Or for example, we want to provide for bad debts. So we have to forecast as to what would be the extent of bad debts in the coming years. Based on that, we will be making provisions for bad debts. So some kind of forecasting also is involved in accounting. So that is another important function of accounting. Third is decision making. Based on the information made available through the financial statements, various decisions need to be taken by different users of financial statements. An investor will use the information in a different manner, whereas an employee will use the same information in a different manner. Ultimately, each one will have to take a decision regarding their continued association with the entity or not. Then comparison and evaluation is another function of accounting. That means on the basis of the accounting information provided, we should be able to compare functioning of the entity with the entity's past. That means what we call time series analysis. That means what has happened in the past as to how the company has fared compared to the past. And secondly, it can also be compared with another entity in the same line of activity. That means what we call pure analysis. So after we have the information, we can find out as to how this entity is doing in relation to its competitors, whether the sales are growing, whether the financial position is getting better or better than the competitors or not. So this kind of comparison and evaluation also is a function of accounting. Then we have control. Ultimately, control needs to be exercised by the management. Control is necessary in order to ensure that the objectives of the entity are met. If the entity is not performing as per expectations, so the management needs to find out as to what is happening, why it is not meeting the objectives, or what are the deviations, and what steps can be taken to bring back the entity to the desired line of activity. So this is called monitoring and control. This is also an important function of accounting. Then finally, accounting also does the function of government regulation and taxation. That means in order for the government to regulate businesses, they also need accounting information, and in order to raise revenue through the form of taxation, government also needs accounting information. So all these functions of accounting are important in the sense that they will enable different users of financial statements, including the government, to have their own idea of what is happening in that particular business. We shall now discuss accounting concepts, principles and conventions. So here we talk of generally accepted accounting principles called GAAP. GAAP are nothing but the rules developed for the preparation of financial statement. They are also described as concepts or conventions or postulates or principles. Accounting concepts define the assumption on the basis of which financial statements are prepared. So these are necessary for the preparation of the financial statement. Accounting principles, on the other hand, are a body of doctrines and serve as a guide for selection of conventions and procedures where alternatives exist. That means accounting principles offer you different kinds of alternatives for preparing the financial statements. In the preparation of the financial statements, you have the option of using different accounting principles which are developed based on certain conventions and procedures. Accounting conventions normally emerge out of accounting practices or principles adopted by various entities over a period of time. Convention is nothing but one which has been followed for a longer period, and over a period of time it becomes a convention. That means it is a custom, it is a practice which is developed over a period of time. So all the three things, that is conventions, principles and practices, are also interchangeably used, and they mean the same thing, that is the principles or practices on which financial accounting theory and practice are founded. So we can say that the accounting principles, conventions and practices are those which are used in the preparation of the financial statements. So let us now talk about some of the accounting concepts which are used in the preparation and presentation of financial statement. There are a number of concepts. Some of the important concepts we will take up. Let us start with the first concept known as the entity concept. This is a very important concept in the sense that this is the basis on which we start accounting businesses. So a business entity or an enterprise is treated as a separate identity distinct from its owner. That means owner and the entity are two different things which should not be confused with one another. Therefore, whenever capital is introduced by the owner, it is treated as a liability in the books of the entity, because it is the money which is to be paid to the owner by the entity. So they are treated as separately. So on account of this entity concept, capital is accounted for as a liability in the books of the entity. Then we have money measurement concept. This concept is very widely used in almost all countries. So only those transactions which can be measured in terms of money are recorded. That means all those transactions where they cannot be converted into money terms will not be recorded. For example, if you want to account for human resources in an organization, they will not be accounted in the books of the entity because they cannot be measured in terms of money. So whatever cannot be measured cannot be treated or recorded in the books of the entity. This is one of the important limitations of accounting also, because those things which cannot be measured will not find a place in recording. So money measurement concept is very important. Then periodicity concept. Normally an entity is continuing in business for a foreseeable future. That means there is no end to the entity. That means it will continue doing business. But for the purpose of preparing the financial statements, we have to demarcate the entire period into different periods. That means the entire life of the entities is split into different periods. Normally this period is for a period of 1 year. So this helps in many ways. First thing is, we will be able to find the financial statement for a particular period, which will enable comparison of the financial statements of different periods, or comparison of the financial statement of one entity with the financial statement of another entity. And this also helps in applying uniform and consistent accounting principles for ascertainment of profits and the financial position, and matching periodic revenues with expenses. Because one of the important concept which will be coming across later is called the matching concept. That means all the expenses incurred during a particular period have to be matched with the revenue earned during that period. So for that purpose it is necessary to have some period. Therefore the periodicity concept helps in splitting the entire life of the entity into uniform periods. Normally it is done on the basis of one calendar year or one financial year. Then we have an accrual concept. In this case, accrual means recognition of revenue and cost as they are earned or incurred, and not as money is received or paid. This is a very important concept. According to this concept, income is recognized only when it accrues to you. That means even if the income is not received, as soon as the entity gets the right to receive that money, it is recognized as income and recorded in the books of the entry. For example, when sales are made on credit, as soon as the sale is made, the entity gets the right to receive the money from the customer who has bought the goods on credit. So even if the money is not received, it is treated as income in the books of the entity. Similarly, in the case of income also, as soon as the expense is incurred, it is recognized as expenditure and not when actual cash is paid. That means the entity incurs expenditure as and when it creates the liability for payment of that amount. For example, when the entity uses power, it is required to pay the power bill. So as soon as the power is used, the entity incurs that expenditure, though normally it pays the bill in the following month, but it has to be recognized as income in the month in which the power has been used. So both income and expenditure are recognized in the books of the entity as and when they are earned or incurred, and not as and when they are paid or received. This is the accrual concept. Then we have a matching concept which we discussed earlier. In this case, we try to match the expenses of a particular period with the revenue earned during that period. That means only revenue accruing to and pertaining to that period has to be taken as revenue of that period, and similarly only expenses which relate to earning that revenue for that period have to be taken as expenses for that period. This is called the matching concept. Then we have a going concern concept. Going concern, as the name suggests, that the entity is a going concern. That means it is likely to continue in business in the foreseeable future. That means it will continue its operations. It is not likely to close down. Only in certain cases this going concern concept is given a go by. For example, if there is a company which is to be liquidated, then it cannot be called a going concern because it is likely to be wound up very shortly. Therefore, the going concern concept is not applicable, but by and large, in respect of all entities, going concept is taken and it is assumed to be there. And then we have the cost concept. Normally, whenever transactions have to be recorded, as we have seen, according to the money measurement concept, they have to be recorded in terms of money, but money is not having a constant value. Money value also changes because of different factors such as inflation. So how to record this is based on the cost concept. So in terms of the cost concept, an entry can be recorded, or the value of an asset or a liability can be recorded on the basis of either historical cost or current cost. Normally, in terms of cost concept, one of the costs is taken, but by and large we follow the historical cost concept. That means the cost at which the asset has been acquired, it is recorded at the same cost and not at the cost at which it will be available in the market. That means we don't go by the current market price, we go only by the cost at which it has been acquired. And the realization concept, according to this, a change in the value of an asset is to be recorded only when the entity realizes. For example, the entity has got land, the land has been recorded at a particular price. The value of the land may be going up, but that will not be recorded in the books unless the entity realizes the value by selling the land. Only when it is sold, then the actual value at which it is sold will be recorded as an entry. Otherwise, land will continue to be recorded at the cost at which it was acquired in the first place. This is as part of the realization concept. Then we have a dual aspect concept. This is what we call the double entry bookkeeping. That means every transaction has got a dual aspect. That means one credit and one debit. For every debit there is a credit, for every credit there is a debit. So in terms of this, we are recording all transactions, and that's why it is called a double entry bookkeeping. That means for every transaction there are two entries, one relating to credit, one relating to debit. Then we have the concept of conservatism. According to this, we follow the principles which are conservative in nature, which says that we should not anticipate income, but must provide for all possible losses. So, all possible losses, even though they have not been incurred actually, have to be provided for if they are likely to happen in the near future. But even if income is likely to come to you, it should not be anticipated. Only when the income is received, it will be recognized as income in the books of the entity as part of the conservative policy of the accounting. So, such a policy is known as conservatism concept. Then we have a consistency concept, according to which all accounting policies which an entity follows in the preparation of the financial statement have to be followed consistently from one period to another. That means, if they are following a particular accounting principle, it has to be continued. It cannot be changed without some valid reason, and for that also without providing the users the reasons for change and the effect of such changes. For example, if an entity is following a written down value method of depreciation, it needs to follow the same method consistently from one period to another. Consistency concept is very important, because if this is not followed, then the financial statements of entities do not become comparable. They lose the characteristic of comparability. If different companies follow different concepts, and if they also keep on changing the principles and concepts, then they lose the concept of comparability, the quality of comparability. Therefore, consistency is a very important concept which needs to be kept in mind. Then we have a materiality concept. Materiality means one which has got a significant bearing on the transactions. So, all items having significant economic effect on the business of the entity should be disclosed in the financial statement. That means, what is material, that is what is materially significant, needs to be disclosed, and what is not material need not be disclosed. And what is material and what is not material depends on the amount of the item, but also on the size of the business and the nature and the level of information. For example, a particular amount of, let us say, 10,000 rupees may not be material for a business which is dealing in crores and crores of rupees, whereas for a small business an amount of 10,000 rupees is material. So, materiality again depends on the circumstances of each case, and depending on that we have to decide whether an item is material or not, and if that item is material, then it has to be disclosed in the financial statements. Now we come to the three fundamental accounting assumptions. This is a very important topic, because normally this has been asked in many of the examinations. So, we have three fundamental accounting assumptions which have to be followed by all. That means, even if they are not disclosed that they are following these assumptions, it is assumed that every entity follows these three assumptions. Therefore, they are called fundamental accounting assumptions. Only if the entities do not follow these assumptions, then they have to be disclosed. If nothing is disclosed in the financial statement, then it is taken for granted, or it is assumed that the entity is following all the three fundamental accounting assumptions. They are: one is going concern, second is consistency, third is accrual. As we have already explained, going concern concept means it is stated that the entity is likely to be in operation in the foreseeable future. That means the entity is not likely to close down its business in the near future. Consistency concept says that all accounting principles and practices or conventions need to be followed by the entity consistently from one period to another, and if there is a change in that, they need to be disclosed. If they are following consistently, then there is no need for separate disclosure. And third is the concept of accrual. That means all income and expenses have to be recognized on accrual basis. That means as and when the entity gets the right to receive the income, it has to be recognized, and not when the money actually comes. And similarly, expenditure has to be recognized as and when the entity incurs the expenditure, and not as and when the entity pays the expenses. So, all these three are important fundamental accounting assumptions they have to be followed in the preparation of financial statements, and when they are followed, the fact need not be disclosed. That means if the financial statements are silent, then it is understood that the financial statements have been prepared based on the 3 accounting assumptions. If, however, any of the above assumptions are not followed, then this fact should be specifically disclosed separately as part of the disclosures to the financial statement, so that the users of the financial statement know that a particular fundamental accounting assumption has not been followed by the entity. Now we will talk a little bit about the various financial statements which are required to be prepared by an entity as part of accounting process. So as we have already discussed, there are 3 important financial statements which are prepared on the basis of the trial balance sheet, prepared after the journalization and posting of the ledger entries. And these financial statements are, one is the profit and loss account, second is the balance sheet, also known as the statement of financial position of the entity, and third is called the cash flow statement. So profit and loss account, as we all know, is a statement of the income and expenditure of the entity for a particular period. That means whatever income the entity has earned during a particular period, normally one financial year, and whatever the expenses have been incurred to earn that income are recorded, and the resultant balance, either it could be profit or it could be loss, is disclosed in the profit and loss account. So this gives an account of the profitability or otherwise of the operations of the entity for a particular period. Therefore, profit and loss account is always for a particular period. That means normally we say profit and loss account as profit and loss account of an entity for the year so and so, or for the year ending 31st March 2012. And balance sheet, as we know, also known as the statement of financial position, gives you the financial position of the entity in terms of assets and liabilities. It details the assets of the entity as well as the liabilities of the entity, and since we are following the double entry system of bookkeeping, the total of assets and total of liabilities match with each other. That means the total of assets will always be equal to the total of liabilities, and this position will be as on a particular date. Therefore, we always say that the balance sheet is as at the end of a particular period. That means as at the close of business on such and such date. Unlike profit and loss account, which is for a particular period, and balance sheet is as on a particular date. And third is called the cash flow statement. As the name suggests, it is a statement of the cash flows of the entity. It includes both the cash inflows as well as the cash outflows. Cash inflows are the cash flowing into the entity in the form of income, and cash outflows are the outflows flowing out of the entity in the form of expenses or in the form of acquisition of various assets. So cash flow statement is very important because the profit and loss account does not reveal the actual position of cash inflows and cash outflows, because as we have already seen, profit and loss account is prepared on the basis of accrual system of accounting, wherein we take all income whenever it accrues, whether the income is actually received in cash or not. Whereas in the case of cash flow statement, we only take into account whatever is the cash inflows and what is the cash outflow on account of either income and expenditure or acquisition of assets or sale of assets or incurring liabilities or paying off liabilities. All these are recorded in the cash flow statement. So that gives an idea as to what is the net cash flow into the company or out of the company, and how that cash is being utilized by the company for its growth and survival. So cash flow statement also is an important statement. All these three financial statements we will consider in detail at a later stage.